Welcome to the video. Today we will demystify why your Roth and traditional 401k balances frequently appear as a single combined number on your dashboard. To build confidence, we will first explain how providers legally segregate these funds, then move into how to find your true split inside your account, and finally address how rollovers separate the funds in practice. Along the way, we will share practical steps and quick checks so you can verify everything yourself. First, we will outline the confusion around combined balances. Next, we will explain why dashboards merge totals. Then, we will assure you that there is no double taxation and demonstrate how providers track sources. After that, we will show you where to find the split in your portal, followed by how rollovers separate funds. We will wrap up with action steps, a quick quiz, and key takeaways. When investors make both traditional and Roth 401k contributions, many dashboards default to showing a single combined balance. This surface-level view understandably causes anxiety because it is not immediately obvious whether contributions and growth are tracked separately. The key question becomes whether the provider is keeping accurate records and whether you might face double taxation later. To address this, we will now clarify the underlying tracking rules. Providers are legally required to track the source of every dollar in your 401k. This includes traditional pre-tax contributions, Roth after-tax contributions, employer matches, which are almost always pre-tax, and the investment earnings attributed to each source. The combined number you see is simply a presentation choice on the dashboard. Behind the scenes, each source has its own ledger. Consequently, when funds are withdrawn or rolled over, the correct tax treatment applies based on the source. Therefore, you will not be taxed twice. Next, let's find the split inside your portal. First, open your 401k portal and navigate beyond the initial dashboard. Then, look for labels such as balance by source, contribution breakdown, investment details, or money type. These areas typically reveal separate totals for pre-tax, Roth, and employer match. If you cannot find this, download a statement or detailed activity report where the split is often listed. Alternatively, contact customer support and ask specifically where to find the balance by source for pre-tax versus Roth. Now, to make searching easier, watch for common labels. Typical entry points include balance by source, contribution breakdown, investment details, money type or source, and holdings by money type. Sometimes the split is embedded in the transaction history using abbreviations such as PRE for pre-tax, ROT for Roth, and ERM for employer match. Recognizing these labels will help you quickly drill down to the true split. Moving forward, this timeline illustrates the journey from contributing while employed to the eventual rollover. First, contributions flow into traditional and Roth sources, and employer matches are tracked as pre-tax. Meanwhile, the dashboard often displays a single combined total for convenience. Then, at a separation event such as changing employers or retiring, a rollover occurs. At that time, the pre-tax portion moves into a traditional IRA, and the Roth portion moves into a Roth IRA. Finally, withdrawals from each IRA follow the correct tax rules for their respective sources. Let's contrast traditional and Roth quickly. Traditional 401k contributions are pre-tax and grow tax deferred. Withdrawals are taxed as ordinary income. Employer matches go into the traditional bucket. During rollover, the traditional portion goes to a traditional IRA. In contrast, Roth 401k contributions are after-tax and qualified growth, and withdrawals are tax-free when conditions are met. Employer matches do not go into the Roth bucket, and during rollover, the Roth portion moves to a Roth IRA. Here is a concise table of tax treatment. Traditional 401k contributions are pre-tax, employer matches are pre-tax, growth is tax-deferred, and qualified withdrawals are taxed as ordinary income. Roth 401k contributions are after-tax, employer matches are not deposited here, growth can be tax-free if qualified, and qualified withdrawals are tax-free. Upon rollover, the traditional portion goes to a traditional IRA, and the Roth portion goes to a Roth IRA. Quiz time. Question: will you ever be taxed twice on the same Roth or traditional 401k dollar because your dashboard shows a single combined total? Options: A. Yes, the system mixes everything and you'll pay twice. B. No, providers track by source and apply correct tax rules. C. Only if you contributed to both Roth and Traditional. D. Only if you change jobs. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is B. Providers maintain accurate source-level tracking for pre-tax and Roth, including employer matches and attributed earnings. The combined total is simply a user interface choice and does not lead to double taxation. Second question. Where does your employer match go in a plan that offers both traditional and Roth 401k? Options: A. Roth 401k. A. Split evenly between Roth and Traditional. C. Traditional 401k pre-tax. D. It depends on your payroll schedule. You may pause the video now to think about the answer. We will reveal the correct option in the next section. The correct answer is C. Employer matches are almost always pre-tax and are deposited into the traditional side of your 401k. As we move ahead, understand that the most visible separation occurs during a rollover. When you change employers or retirees, administrators split the account by source. The pre-tax portion is transferred to a traditional IRA, and the Roth portion is transferred to a Roth IRA. This process is methodical and ensures each dollar keeps its correct tax status for future withdrawals. To take action, log in and find the balance by source or money type view. Verify that your employer match appears under the pre-tax or traditional category. Download your latest statement and confirm separate totals for traditional and Roth. Record a quick note of your current split, for example, 70% traditional and 30% Roth. If anything is unclear, send a message to customer support requesting the exact location of source-level balances. This pie chart illustrates a hypothetical composition. For example, 65% might be traditional, 25% might be Roth, and 10% might be employer match, which is pre-tax. The exact percentages will vary based on your contributions and matching schedule. But this visualization underscores that the combined total can represent multiple distinct sources. Here are the key takeaways. First, dashboards frequently show a single total, but funds are tracked by source. Second, employer matches are almost always pre-tax and tracked separately. Third, there is no double taxation because withdrawals follow the tax rules for each source. Fourth, you can find the split through balance by source or money type views. Finally, rollovers separate pre-tax funds to a traditional IRA and Roth funds to a Roth IRA. In summary, the combined number you see is simply a display choice rather than an indication of mixed tax treatment. Providers maintain accurate ledgers for traditional, Roth, employer match, and the growth associated with each. You can verify the true split by drilling down to source-level details in your portal. During a rollover, the plan separates funds into the appropriate IRAs, ensuring correct tax treatment continues. Before we close, a quick disclaimer. This content is educational and does not constitute financial, tax, or legal advice. You should consult with a qualified professional who can review your specific circumstances before making any decisions. Thank you for watching. If this video helped you see beyond the combined total, please like the video, share it with someone who contributes to both Roth and traditional 401k, and subscribe for more. Finally, let us know your questions or insights in the comments.